Well, 2022 is pretty much a year to forget for investors. Right now, you must be feeling a bit lost where opportunity could be lying given the huge uncertainty in the stock market. However, there's one group of stock that seems to be holding up relatively well in this environment, and they are our Singapore banks. The top three banks in Singapore, namely DBS Group Holdings, OCBC, and UOB, have all shown positive return this year for investors. And fundamentally, the three bank has been growing quite impressively over the past few years as well, both through organic growth and acquisition. So far, all the strategy seems to be working pretty well for them. So today, let's explore what's happening between each of them and find out what are their differences and prospect going forward. Number one is DBS Group Holdings. Well, DBS is the largest bank in Singapore and also Southeast Asia. The bank has a long history in Singapore and have since expanded its presence across Greater China and also Southeast Asia. Among the three banks, DBS Group might be the most aggressive when it comes to investing in technology. The company has spent huge capex on building up its technology infrastructure, from its data center to back-end software and also customer-facing application. The bank was also one of the first to start implementing digital banking services across the market. This shows that DBS is quite willing to experiment and explore new ways of doing business, which is always a good thing. Apart from growing its traditional commercial and personal banking segment, one of the key growth that's coming from this bank is actually in the private wealth space. Actually, all of the Singapore bank has been aggressively taking over the private wealth space in Southeast Asia after the global financial crisis in 2008. Since then, many Western banks has been looking to offload their operation in Asia Pac, and DBS Group has been one of the more active acquirer. The company has since bought over Société Générale Private Wealth Business in Asia and also ANZ Asian Business. It has also bought over the consumer side of business from Citibank Taiwan this year. The strategy seems to be working well for DBS as it has been able to grow its revenue from 12.2 billion in 2017 to the current 14.2 billion. And today, the company counts Hong Kong as its second largest market, which make up about 17% of its revenue in the first half this year. DBS Group really gained a stronghold in Hong Kong through both organic growth and also its acquisition of Tao Heng Bank back in 2001 for $7 billion. In terms of its fee income, its wealth management is still the main contributor, followed by cards and transactional services. Right now, DBS Group has a very strong position in Singapore, taking up the largest market share of deposits in Singapore. Given the strong saving rate and low funding costs, the bank has been able to weather through most downturn in the past few decades. Moreover, with the increase in uncertainty surrounding China and US, Singapore is becoming more of an attractive place for investment and businesses for international clients. But of course, that would also mean that its second largest market, Hong Kong, could be facing more pressure going forward. Right now, DBS Group Holdings is trading at around 1.6 times its book value, which is much higher than its 5-year average of 1.2 times. Yet, it is still providing a pretty attractive dividend yield of 4.1%. However, when we look at its valuation compared to its peers, DBS Group is looking more highly valued at the moment. And now, before we go on to our next company, I would like to thank our sponsor for this video, Seeking Alpha. Seeking Alpha is the largest investment community in the world, and it provides investors with a wealth of information through its database, news, earnings transcript, and also crowdsourced analysis. Both personal and also professional investors are finding great investment ideas through Seeking Alpha. And personally, I use it to keep up to date with companies that I'm interested in. And right now, you can also sign up for Seeking Alpha with more than 50% discount from their premium membership. And if you want to find out more, remember to check on our link below. Now, let's get back to the video. Next, we can look at Overseas Chinese Banking Corporation, or OCBC. The story of OCBC is very similar as well. The company has a long history in Singapore and still counts Singapore as its largest market, taking about 49% of its operating profit. Yet, its business in Singapore is considered to be much smaller compared to these two other peers. Today, the company counts Greater China and also Malaysia as its next biggest market. The bank also has a slightly different revenue mix compared to its competitor, mainly due to its huge investment in insurance through its majority stake in Great Eastern. Today, insurance take up about 18% of its operating profit. OCBC has been growing rapidly through acquisition over the past few years. It's expanded regionally through its investment in PT Bank NIP in Indonesia, in Wing Hang Bank in Hong Kong, as well as a 20% stake in Bank of Ningbo back in 2006. On top of that, OCBC has been building up its private wealth business through its subsidiary, Bank of Singapore. It was formed after acquiring ING Private Wealth back in the global financial crisis. Since then, the bank has really grown by acquiring more private wealth business such as Barclays, National Australia Bank, and others throughout the region. Unlike its peers though, OCBC seems to be using a different type of branding strategy. The company has chosen to use a different branding for each different segment of the market. For example, its main business is under OCBC, but its private wealth is under Bank of Singapore. It has another subsidiary called Frank for its youth and younger customers, while having Great Eastern as its insurance arm. This might mean that the company might need to spend much more in marketing in order to reach out to all its customers. But right now, the main growth for OCBC could still be coming from Singapore. The potential rise of Singapore as a more important financial hub in the region could still help OCBC in its growth path. And given its active stance in acquisition over the past few years, we can feel that the company could continue to use this strategy to grow in the future. Moreover, with arm in insurance and also private wealth, OCBC should be able to continue to grow at a moderate pace with its diversified business. Right now, OCBC is trading at just 1.05 times its book value, which is much lower than its long-term average of 1.2. However, in terms of dividend, the company is also giving out the most dividend yield at the moment at 4.6%. So, OCBC definitely look much more interesting compared to DBS at the moment. And finally, let's look at United Overseas Bank or UOB. To me, I see UOB as the last family-owned bank in Singapore. Given that OCBC is actually majority owned by a foundation and is professionally managed, I don't really consider it as a pure family-owned bank. UOB, on the other hand, is still majority owned by the Wee family and managed by family members. Of course, there are pros and cons by investing in a family-owned business. For one, UOB is still the largest asset for the Wee family, and we should be assured that they will be very prudent in managing and maintaining the business. But on the other hand, with the family having such a tight control on the bank, it would also mean that we are exposed to both the ability of the family members to manage the business and also their willingness to share this profit with minority shareholders. Today, UOB is considered the smallest among the three banks with a market capitalization of 50 billion, which is just slightly smaller than OCBC. But UOB has still been very successful in keeping up with the growth rate of its peers. And similar to DBS, it has also been investing heavily in technology as well, rolling out its digital bank services across Southeast Asia. Right now, apart from Singapore, which take up about 56% of its operating profit, UOB counts Malaysia, Thailand, and also Greater China as its key markets. In terms of growth, UOB is also growing in similar areas as well. Its wealth management business is one of the fastest growing segments for it, and compared to its peers, it has more exposure to the Southeast Asian market, mainly from its key market like Malaysia and Thailand. In that sense, UOB is also traveling in the same prospect route as its competitor. The bank should continue to do well if Singapore continues to be a relevant and competitive financial hub. Basically, all three banks should continue to do well as long as Singapore continues to be a great financial hub. In terms of valuation, UOB is trading at a price-to-book ratio of about 1.2 times, which is in line with its long-term average. And when we look at its dividend, it has the lowest yield among the three, with a dividend yield of just 4%. So if you're looking at a valuation standpoint, I think that UOB and OCBC are trading at a more reasonable valuation right now. But when choosing among the three banks, it still comes down to your own preference. If you prefer a bank with more diversified income in terms of its business segment, then OCBC might be one more attractive to you. But if you prefer a bank where it's more Southeast Asian focused, then UOB might be the one for you. So which of the three banks is your favorite? Let me know in the comments below. And of course, if you have gotten value from this video, please give us a like and share it with a friend who you might think will benefit from it as well. And please check out our sponsors Seeking Alpha on how they can help you in your investment journey. You can always support our channel by supporting them. So remember to click on the link below to enjoy a 50% discount from their membership. Anyway, as always, my name is Stanley. Till we meet again, invest safely.